When people talk about the stock market, it often feels like an unstoppable force, rising higher and higher with no end in sight. But history has shown us time and time again that what goes up too fast often comes crashing down just as quickly. Right now, beneath the surface of record-breaking highs in optimism, there are warning signs that very few are paying attention to. From overinflated valuations to rising debt costs to hidden risks buried deep in the financial system, and the foundation of this market may not be as stable as it seems. And if these cracks widen, it could trigger a sharp correction, one that catches most investors completely off guard. The first red flag that points toward the possibility of a market crash lies in the extreme valuations we're seeing today. Historically, investment markets have always cycled through periods of overvaluation and correction, but what makes the current situation more concerning is how detached prices have become from the actual fundamentals of businesses. And then when investors look at traditional metrics like the price to earnings ratio, the price to sales ratio, or even dividend yields, the numbers paint a picture of a market that's trading at levels we only tend to see before major downturns. For instance, when companies are valued at 30, 40, or even 50 times their earnings, it raises the question, how sustainable is that? Earnings would need to grow at an extraordinary pace for years to justify such prices. And history shows us that this kind of growth is rarely maintained. What often happens instead is that reality catches up, earnings disappoint, and stock prices eventually realign with fundamentals, often in a violent way. Another aspect that fuels these excessive valuations is speculation. In recent years, investors have been pouring money into high growth, high risk sectors with the hope of massive returns, pushing stock prices well beyond reasonable levels. This is reminiscent of past bubbles like the dot-com boom of the late 1990s, where companies with little to no profitability were valued in the billions simply because they carried the tech label. The same kind of mindset is alive today, investment, except it's spread across multiple industries, technology, artificial intelligence, electric vehicles, and even speculative assets outside the stock market. When money floods into these areas without discipline, it creates bubbles that look solid on the surface but can burst without warning. One of the reasons valuations have climbed so high is the prolonged era of cheap money. For years, central banks kept interest rates near zero, making it extremely easy for companies and investors to borrow and invest aggressively. This environment didn't just fuel economic growth, it encouraged risk-taking at unprecedented levels. When money is cheap, people are willing to pay more for stocks, real estate, and other assets. But now that rates are rising, the equation changes. Those sky-high valuations, once supported by low borrowing costs, suddenly look unsustainable because the cost of financing growth is higher and the expected returns shrink. Investors who were once willing to pay almost anything for growth begin to rethink what they're willing to risk. Another layer to this problem is that valuations are not evenly distributed across the market. A handful of large companies have driven the majority of the market's gains, creating an illusion of broad market strength when in reality, much of the market is lagging behind. This concentration risk makes the market even more vulnerable. If just a few of these overvalued giants stumble, the impact could ripple across the entire market, dragging down indices and triggering a wave of panic selling. It's like a house of cards. It looks strong when it's standing, but take away one or two crucial supports and the entire structure collapses. Investors also tend to underestimate the psychological element of valuations. When prices rise rapidly, optimism becomes the dominant sentiment. People believe prices will keep going up simply because they have been going up. Investment. This herd mentality is what keeps bubbles inflated longer than fundamentals justify. But the moment sentiment shifts even slightly, the same psychology that pushed prices higher can push them down at lightning speed. Once investors start to doubt whether a company is really worth 50 times its earnings, they begin to sell. And when selling starts, others follow, fearing they'll be the last ones holding overpriced assets. Looking back at history, every major crash from the Great Depression to the dot-com bubble to the housing crisis was preceded by excessive valuations and speculation. It's almost always the same story, just in a different form. Investment. People convince themselves that this time is different, that new technologies or new economic conditions justify sky-high prices. But in the end, fundamentals always reassert themselves. Earnings, profitability, and real economic output dictate long-term value, not hype or hope. When there's a wide gap between what investors are paying and what those fundamentals actually support, that gap eventually closes. And it usually closes fast. The risk we face today is not just that valuations are high, but that they are dangerously high in a fragile global environment. Companies are dealing with higher costs, uncertain consumer demand, and geopolitical instability. If the economy slows down even slightly, it's hard to imagine how companies can deliver the kind of earnings growth that would justify current prices. That disappointment would be enough to trigger a revaluation across the board, leading investors to pull back en masse. And once that momentum builds, it can quickly spiral into a crash. So, when we talk about the hidden risks in today's market, excessive valuations are one of the clearest signals. They show us a market that is pricing in perfection, endless growth, stable conditions, and low risk. But perfection almost never lasts. All it takes is one or two shocks, whether it's disappointing earnings, a global slowdown, or a geopolitical event for the illusion to break. And when it does, those sky-high valuations won't just come down gently. They'll collapse in a way that reminds us all that fundamentals matter. And that speculation and optimism can only carry the market so far before reality sets in. The second major factor that could push the stock market toward a crash is the impact of rising interest rates and the growing cost of debt. For over a decade, markets have been fueled by an environment of historically low interest rates. Cheap borrowing created a unique situation where companies, consumers, and even governments could access capital with minimal cost, enabling aggressive spending, investment, and expansion. This easy money environment didn't just sustain economic activity, it actively encouraged risk-taking, investment. But when the tide turns and interest rates begin to rise, as we've seen recently, the effects ripple across the entire financial system, creating vulnerabilities that few investors fully account for until it's too late. One of the most immediate impacts of higher interest rates is the increased cost of borrowing for corporations. Many businesses, particularly in high-growth industries, rely heavily on debt to finance expansion, acquisitions, and day-to-day operations. When interest rates were near zero, this debt was cheap and manageable. But as rates climb, refinancing becomes more expensive, eating directly into corporate profits. For companies already operating on thin margins, these added costs can quickly turn growth into stagnation or profitability into losses. Investors who once valued these companies based on aggressive growth assumptions suddenly face the reality that those projections may no longer be feasible. That disappointment leads to a reassessment of stock prices, often resulting in sharp declines. Rising interest rates also affect consumer behavior, which has a direct impact on company revenues. In an environment of cheap credit, when consumers are more willing to borrow to buy homes, cars, or even everyday goods, this willingness drives demand, which in turn fuels corporate growth and stock market optimism. However, when interest rates rise, loans for mortgages, auto financing, investment, and credit cards become more expensive. As consumers feel the pressure of higher monthly payments, discretionary spending starts to shrink. Retailers, service providers, and even tech companies that depend on consumer demand begin to see slower growth. As this slowdown becomes apparent in quarterly earnings reports, investor confidence can falter, leading to widespread sell-offs. Another crucial element is how interest rates influence the valuation of stocks themselves. In finance, the value of a stock is often calculated by discounting future cash flows back to their present value. When interest rates are low, the discount rate is low, which makes future earnings appear more valuable today. But as rates rise, the discount rate rises too, which reduces the present value of those same future earnings. This mathematical relationship means that even if a company's actual earnings don't change, higher rates automatically make its stock less valuable in the eyes of investors. And this is especially damaging for high-growth companies whose valuations are based on earnings far into the future, rather than current profits. Beyond corporations and consumers, rising rates also strain governments and financial institutions. Governments with massive debt loads face higher costs to service that debt, which can limit their ability to stimulate the economy during downturns. At the same time, investment banks and lending institutions must navigate the risks of defaults as both businesses and households struggle under the weight of higher borrowing costs. These systemic pressures create an environment where a small shock, such as an unexpected drop in corporate earnings or a spike in unemployment, can have outsized effects on financial stability. Investor psychology plays an important role here too. When rates are low, the stock market becomes the most attractive place for investors seeking returns because safer alternatives like bonds or savings accounts offer little reward. But when rates rise, bonds and fixed income assets begin to look more appealing. This shift pulls money out of the stock market as investors chase safer yields. The result is not just reduced demand for equities, but also the potential for sudden corrections as large amounts of capital exit the market at once. We've already seen early signs of this dynamic play out. Sectors like technology and real estate, which thrive in low-rate environments, have been hit particularly hard when rates rise. Tech companies, many of which rely on growth projections and heavy borrowing, see their valuations cut dramatically as the cost of money increases. Real estate markets, heavily dependent on mortgage affordability, experience a slowdown as higher interest rates price potential buyers out of the market. These declines are not isolated. They create ripple effects across related industries and can drag down broader market indices. The danger here is not just that interest rates are rising, but that they're rising in a fragile global economy where many companies and households are already stretched thin. A decade of easy money encouraged excessive borrowing and risk taking, and now the bill is coming due. And companies face refinancing at higher rates, consumers face mounting debt payments, and investors are beginning to realize that the valuations they once justified no longer make sense in this new environment. Investment. When you add all of these factors together, the picture becomes clear. Rising interest rates don't just increase the cost of debt, they fundamentally change the dynamics of the market. They reduce corporate profits, weaken consumer spending, lower stock valuations, and shift investor preferences towards safer assets. It's a chain reaction that can quickly unravel the optimism propping up the market. And if history is any guide, once that unraveling begins, it can accelerate rapidly. Investment, turning what looks like a healthy market correction into a full-blown crash. One of the most overlooked dangers in the financial system today is the hidden leverage and systemic risks that quietly build up beneath the surface. Unlike valuations or interest rates, which are visible and widely discussed, these risks often remain out of sight until they suddenly erupt, catching investors completely off guard. Leverage, in simple terms, is the use of borrowed money to amplify returns. While it can make gains look spectacular when markets are rising, it also magnifies losses when markets turn downward. Investment. The problem is that leverage has seeped into so many layers of the financial system, individual investors, corporations, hedge funds, and even entire economies, that a small disruption in one area can cascade into a widespread crisis. And one major example of this hidden leverage is margin trading, where investors borrow money to buy more stocks than they could otherwise afford. During bull markets, margin debt tends to soar as investors feel confident that stock prices will keep climbing, making it seem like a low-risk strategy. But when prices start to fall, those same investors face margin calls and forcing them to sell their holdings quickly to cover losses. This forced selling puts additional downward pressure on stock prices, creating a vicious cycle that can rapidly spiral out of control. Historically, spikes in margin debt have often preceded market downturns, and today the levels of margin trading are alarmingly high. Corporations are another major source of hidden risk. Over the past decade, many companies took advantage of low interest rates to load up on debt, not just for expansion, but often for stock buybacks and dividends to appease shareholders. On the surface, these moves made stock prices look strong, but underneath, they created fragile balance sheets dependent on cheap borrowing. Now, as interest rates rise and cash flows tighten, these highly leveraged companies face a dangerous squeeze. If revenues fall or borrowing costs climb further, defaults could increase, leading to a ripple effect across the broader market. Investors who assumed these companies were financially solid may suddenly find themselves holding stocks in businesses that cannot sustain their debt obligations. Financial institutions themselves can also carry hidden risks that amplify market instability. Hedge funds and investment firms often use complex strategies involving derivatives, swaps, and other instruments that rely heavily on leverage. These strategies work smoothly as long as markets remain stable, but when volatility spikes, the losses can be catastrophic. A clear example of this was the collapse of Archegos Capital in 2021. Where a single family office using excessive leverage triggered billions of dollars in losses across major banks. That was just one firm. The concern is that there are many more such entities quietly operating with similar levels of hidden leverage, and we won't know the extent of the exposure until something breaks. Beyond individual institutions, systemic risks also emerge in the broader financial ecosystem. The global economy is interconnected in ways that make it extremely difficult to isolate problems. A crisis in one sector or country can spread quickly across borders, investment magnified by the leverage embedded in the system. For example, a debt crisis in emerging markets could destabilize global banks that are heavily exposed, which in turn could create liquidity shortages in US and European markets. In a leveraged environment, what looks like a small, localized issue can quickly become a global shock. Another hidden danger is the reliance on derivatives and complex financial instruments that most investors don't fully understand. These tools are often used to hedge risks, but in practice, they can create massive exposure if markets move in unexpected ways. During the 2008 financial crisis, investment, mortgage-backed securities, and credit default swaps were at the heart of the collapse, instruments that seemed safe until they suddenly weren't. Today, the market is flooded with equally complex products tied to interest rates, currencies, investment, and commodities. The sheer size of this derivatives market means that even a small miscalculation can set off a chain reaction that destabilizes the entire system. But the real danger with hidden leverage is that it tends to remain invisible until stress tests the system. During good times, everyone assumes the risks are manageable. But when volatility hits, the true extent of exposure is revealed, often too late to prevent damage. Investors then scramble to unwind positions. Institutions tighten credit, and liquidity dries up, creating the perfect conditions for a crash. What makes this so dangerous is that most investors and even regulators cannot see the full picture. They may have a general sense that leverage is high, but the exact numbers, strategies, and connections are obscured until they unravel in real time. Investor psychology also plays into this risk because leverage amplifies returns during bull markets. It fuels overconfidence and a belief that the market is invincible. This mindset encourages even more borrowing and risk, taking further inflating bubbles. But once the tide turns, the same leverage that created massive gains becomes the accelerant for devastating losses. As panic sets in, the sell-offs become self-reinforcing, dragging the market down much faster than it would fall under normal conditions. The lesson from past crises is clear hidden leverage is often the silent trigger behind market collapses. It's not always the most obvious factors like valuations or interest rates that cause the initial spark. It's the highly leveraged positions that implode when the environment shifts. In today's market, where debt levels are at record highs across households, corporations, and governments, the systemic risks are greater than most investors realize. This is why hidden leverage is such a critical point to understand when analyzing the possibility of a stock market crash. It's not just about what we see on the surface, the earnings reports, the headlines, or the economic forecasts. It's about what we don't see: the massive bets, the borrowed money, the fragile positions built on assumptions of endless stability. And history tells us that when those assumptions break, the consequences spread fast and wide, turning what might have been a manageable downturn into a full-scale crisis. Global uncertainty and investor sentiment are two of the most unpredictable yet powerful forces in determining the direction of the stock market investment, and together they represent one of the most immediate risks of a potential crash. While valuations, interest rates, and leverage can set the stage for instability, it is often sentiment that pulls the trigger. Markets are not purely rational systems driven only by numbers. They are reflections of human psychology shaped by fear, greed, optimism, and panic. In times of global uncertainty, these emotions swing more violently. Investment, creating conditions where a sudden change in confidence can send markets tumbling almost overnight. One of the biggest sources of global uncertainty today is geopolitical tension. Conflicts between major powers, wars in different regions, or even trade disputes have ripple effects that reach far beyond the countries directly involved. Investors watch these developments closely, and even the possibility of escalation can cause sharp movements in stock prices. When global trade routes are disrupted or energy supplies are threatened, markets react by pricing in higher risks. We've seen this repeatedly in history, from oil shocks in the 1970s to more recent supply chain breakdowns caused by political conflict. Each of these events shows how quickly global uncertainty can undermine the sense of stability that markets depend on. Economic slowdowns also fuel uncertainty. Concerns about recessions, rising unemployment, investment, or slowing consumer demand create an atmosphere of doubt. Investors start to question whether corporate earnings projections are realistic, and when expectations fall, stock prices follow. What makes this dangerous is that sentiment doesn't always wait for confirmation of bad news. Even rumors or early signs of weakness can spark sell-offs as investors rush to get out before the situation worsens. And this tendency to anticipate negative outcomes often accelerates downturns, making them more severe than they might otherwise have been. The interconnectedness of global markets amplifies the effects of uncertainty. A crisis in one part of the world can spread rapidly across borders. For example, debt issues in Europe can impact US banks, while currency fluctuations in Asia can destabilize global trade. Investors know this, which is why even small shocks in seemingly distant markets can create large reactions in major stock indices. In a globalized economy, uncertainty anywhere is uncertainty everywhere. And this broad sense of vulnerability adds fuel to the fire of market instability. Investor sentiment itself is a fragile force that can swing from euphoria to fear with surprising speed. When markets are rising, optimism dominates, and investors convince themselves that growth will continue indefinitely. This optimism drives more investment, pushing prices even higher. But the higher prices go, the more fragile confidence becomes. All it takes is one negative headline, one unexpected earnings miss, or one geopolitical flare up to shift the mood. And once sentiment turns, fear spreads faster than optimism ever did. Investors rush to sell, worried about losing gains, and as selling accelerates, panic sets in. This cascade of fear-driven selling is often the immediate cause of crashes, regardless of whether the underlying fundamentals have changed significantly. Social media and instant information make sentiment shifts even more volatile today than in the past. News travels in seconds, and narratives spread rapidly across millions of investors. A rumor, a viral post, or a sudden change in headlines can cause markets to swing dramatically in a single trading session. The speed of information amplifies herd behavior, where investors don't take time to analyze facts, but instead react emotionally to whatever the crowd is doing. This environment makes markets more sensitive to global uncertainty as the line between perception and reality becomes blurred. Investment. Another important factor is how institutional investors and algorithms respond to shifts in sentiment. Many large funds and trading systems are designed to react quickly to market movements. When volatility increases, algorithms may trigger automatic selling to minimize losses, while institutions may reallocate assets to safer positions like bonds or cash. These rapid responses can drain liquidity from the market, turning a small downturn into a sharp correction. Retail investors seeing the sudden drop often follow the trend by selling their positions, accelerating the decline. Sentiment, once it turns negative, becomes self-reinforcing. The role of uncertainty in shaping sentiment is also tied to trust in leadership and policy. When governments and central banks appear decisive and capable of managing crises, investors may remain relatively calm. But when leadership seems uncertain, inconsistent, or reactive, confidence erodes quickly. Mixed signals about interest rate policies, unclear fiscal strategies, or delayed responses to global crises all feed into a perception that the system is unstable. Once confidence in leadership fades, markets lose an anchor, and sentiment can collapse almost instantly. History provides countless examples of how uncertainty and sentiment combine to trigger crashes. The Great Depression was exacerbated by panic selling as trust in the system vanished. The 2008 financial crisis unfolded not just because of bad mortgages, but because investor confidence evaporated once it became clear that major institutions could fail. More recently, during the early months of the global pandemic, stock markets around the world collapsed in a matter of weeks, not because every company suddenly became unprofitable, but because uncertainty about the future overwhelmed investor psychology. These examples highlight that uncertainty and sentiment don't just accompany crashes, they often cause them. The key danger in today's environment is that uncertainty is unusually high across multiple dimensions: geopolitical conflict, inflation pressures, supply chain fragility, and debt burdens. At the same time, valuations remain stretched and leverage is widespread, leaving the market little room for error. In such a fragile system, sentiment becomes the deciding factor. If optimism gives way to fear, the shift will not be gradual. It will be swift and severe. And because sentiment is contagious, once fear sets in, it spreads far beyond the initial cause, pulling the entire market down with it. This is why global uncertainty and investor sentiment represent one of the most immediate risks for a market crash. Unlike other risks that build slowly, sentiment can change overnight. A single unexpected event, a shocking headline, or a sudden policy misstep can shatter confidence. And when confidence breaks, the market's foundation crumbles quickly, leaving investors scrambling in a panic-driven sell-off. In the end, it's not just the numbers on balance sheets that drive markets, but the psychology of those who invest in them. And in uncertain times, that psychology can turn dangerously fragile.